Hey, well, welcome to Unit 3 Risk Assessment. So if you remember back to the timeline we talked about in the framework chapter, outlining the various phases of the audit process, the first one being the pre-engagement process, which we've talked about in the last chapter. The next stage of the audit process is the planning or the initial risk assessment. So I mentioned in this previous chapter that this part was really important, because as part of your audit process where you're trying to maximize your efficiency of the audit, a very important thing is to think about on a client-specific basis, where are the risks lying? How risky is this particular client? And what kind of risk might be specific to this industry or the specific company and so forth. Obviously, if it's a high-risk client, you've got to do more work and insert in the risk areas than if it's a low-risk company. Now, why this is so important is because, again, going back to this idea of efficiency of the audit, we have limited resources in the world. We can't check every single transaction. So we have the highest chance of identifying fraud or material misstatement by looking in those risk areas where it's likely to be an issue. So as a general overview of the risk assessment process is auditors gather information about the entity to identify and assess risk of material misstatement, or ROM, which can result from either error or fraud. It's a risk-based audit approach is the name of the concept that we're discussing. It's understanding the areas of greatest risks. The auditor can plan their audit so they spend most of their time and effort in focusing on these risk areas. It's really important to understand the entity and its environment, and this is a continuous process, and this forms the basis of number one, assessing risks, number two, determining materiality or what the threshold is to identify whether risk is important or not. Number three, considering the appropriateness of an entity's accounting policies and FinStat disclosures. Number four, identifying areas that require specific testing, e.g. complex transactions, significant estimates and judgments, or management uses of the going concern assumption. So going concern, by the way, means whether or not the company is going to continue operating in the near future. Number five is designing audit procedures. So how are we actually going to go and practically test the company? What are the controls we're going to do? What are the substantive procedures that we're going to do? If you're not sure what those are, we're going to be talking about them in later chapters, which directly respond to the risks identified. And then finally, evaluating whether the audit evidence is sufficient and appropriate. Okay, so assessment procedures. So at bare minimum, auditors perform risk assessments to identify and assess levels of risk of material misstatement at the financial and assertion level. So at minimum, auditors must perform the following procedures. Number one, inquiries of management and others within the entity. Number two, analytical procedures. Number three, observation and inspection. Note that risk assessment procedures alone do not provide sufficient appropriate audit evidence on which to base an audit opinion. Pause there for a second and discuss this sentence here, that at both the financial statement and assertion levels. So what does that mean? This is a really important concept, and something that comes up in exam questions all the time is actually identifying each of the assertions or potentially coming up with a test to ensure the assertions or the different assertions are accurate. So we'll just talk about it at a high level first, and then as we go through the chapters, we'll go through in more detail and more specific. So part of the audit, right? Well, the primary purpose of an audit is to identify and assess risk of material misstatements. We've already gone through that in previous chapters. I think we're all across that. And that can be either through fraud, so people intentionally doing something wrong, or it could be an error, so people not intentionally doing something wrong, but it's still resulting in something wrong. Okay, we know about that. The issue is the next step to learn is where those misstatements might be. So there's two areas those misstatements could be. So number one is at the financial statement level, and number two is at the assertion level. So at the financial statements, it's to do with the whole financial statements. For example, we discover later that there's an error with the accounting system that actually adds a number times 2 to every single transaction across the financial statements. So what this means is everything in the financial statements are impacted. The whole financial statements are wrong. Okay, that's at the financial statement level. we also want to test at the assertion level. Now, the assertion are certain assumptions or statements about a certain area of the financial statements. For example, valuation of inventory. Management might be saying the valuation of inventory is accurate. This is one assertion, and we need to go in and test that. Another one might be is that the stock count is complete. The number or the asset valuation for a certain line item in the P&L or balance sheet is complete. And then the auditor needs to go, okay, I appreciate you're saying that, but because of professional skepticism, I need to go in and test that myself. So they go in, they have a look and say, oh, actually, they're missing this, this, and this. And if we did include them, the financial statements would look like this. So financial statements is a much higher, broader concept, whereas assertion levels are looking at very specific things and the assumptions around that and what has been told to us by management. We're going to go and check that. So that's basically the simplest explanation I could give you of what those different things are and why it's important. Okay, so let's talk about the minimum things that auditors must do. And you might get a multiple question on this, the minimum things that an auditor must do. So number one is inquiries of management. So usually the starting point for auditors is to just go and meet with management and ask them questions. And part of that is just talking to management and ask them what do they consider the key risks to the business, because they know the business, they know the industry better than most, especially more so than the auditor, and also how that company is responding to those risks. Because management is usually in the best position to perpetrate fraud, inquiries of management are not likely to provide useful insights regarding misstatements resulting from management fraud. So it's more about identifying what are the industry risks, how does a business, so it's getting an understanding. It's not saying, have you had fraud in the business? Because yes, the most likely perpetrators, they're mostly not going to give you the truth anyway, so what's the point in asking? So therefore, the auditor would corroborate management responses with inquiries of others at all levels of the entity. The auditor is required to obtain an understanding of how those charged with governance exercise their oversight and inquire whether those charged with governance have an actual knowledge of any actual suspected or alleged fraud. Specific inquiries that must be made by the auditor in ISA 1315 and ISA 240, you don't need to remember these numbers by the way, e.g. a requirement to inquire of management as to its process for identifying and responding to risks of fraud, including any instances of fraud that they have identified. So it's more around testing the processes and controls that exist. Where an internal audit function exists, its activities should include consideration of risks and controls in relation to fraud. The auditor to specifically inquire of internal audit whether it has any knowledge of any actual suspected fraud. And there's an example checklist of some of the questions you might be asking them about this. Okay, so the next one is analytical procedures. So this is number 2 on the minimum things that auditors must actually do as part of an audit process. So analytical procedures. The auditor must perform analytical procedures over the entity's most recent financial information that is available, so it must be recent, and then compare this information to the same period from in the previous year. This allows auditor to identify risky areas or amounts, ratios, or trends that the auditor should investigate further. So if you've done math, it's quite similar. Math is management accounting. It's basically they give you a series of P&Ls and you have to look at trends and actually comment it. For example, revenue might be increasing and looking at the background information and saying revenue is increasing in the P&L, but the background information is suggesting that there's a new competitor or something like that. And therefore, we can expect revenue to decline this year. So this is potentially an area that we should be looking at because the actuals don't actually correlate with the story. And that's an example of using an analytical procedure to help guide your risk assessment. So as the data capabilities of both audit clients and audit firms increase, auditors are increasingly starting to leverage data analytics at the risk assessment stage of the audit to analyze and profile entities' accounts. So it's starting to become more and more of an important area of audits, is just doing that data analytical to find the areas and make audits more efficient, the areas that they should be looking at for risk areas. And then finally, the third thing that auditors must do at minimum is observation and inspection. So this helps support the other risk assessment procedures by substantiating findings from discussion and help an analysis, as well providing additional information about the entity environment. So for example, as part of this planning process, you might go and actually inspect. For a trucking company, you might go and inspect all the trucks. So first of all, you're checking for completeness and make sure all the trucks are actually there that we're saying is on the balance sheet. Number two, you could be checking for any degradation. For example, we might go out there and say, oh, these trucks, they're barely starting. I saw one truck missing a bunch of parts. I saw another one that can't even start its engine. We're saying that these assets are worth X amount, but in reality, they're only worth Y amount. So why are we showing this in the balance sheet? So we've got some examples here for inspection of documents. Could be industry media reports, could be business plans, strategies and proposals, could be major contracts, commitments, internal control manuals, minutes from meetings, and so forth. Okay, and other information obtained as part of the audit process. So the audit firm may already know a lot about the entity. For example, they may have audited them for many years. They may have different engagements with them. You might have a due diligence or an advisory engagement with them, which you can derive information from. You might even have audit team members who have previously worked with members of the entity's management team, or you might have acquired it through external sources. So this is really important to understand the entity, as I mentioned before, because it helps you form your opinion on risk. So there's a few different ways that you can understand about the entity, which is within the internal area of the company that you are auditing, and also the external environment. So these can be industry, regulatory, and other external factors. Number two, nature of the entity. Number three, accounting policies. Number four, objectives and strategies. Number five, measurement and review. So going through these one by one. So industry, legal, regulatory, and other external factors is the first one. So, for example, depending on the industry that you're in, it may give rise to specific risks. So the textbook gives us some examples over here. So competition, for example, clothes retailer operating in highly price competitive industry. The potential impact on the entity is that price competition may have an adverse effect on operating margins. Another example is demand. There could be a seasonal demand in a particular industry for a utility company, for example, and those fluctuations in demand may have a negative impact on cash flows. To see this logical process that we're going through, we're thinking about, okay, first of all, let's consider industry. Number two, what are the potential impacts from industry on this particular entity that we're auditing? So we might say competition, demand, commodity price, nature, industry. Okay, and then we're going, okay, so what's a specific example of, let's say, laws and regulations impacting maybe the banking industry might be your client? Okay, well, we know that the AFSL, the financial service licenses regulations, impact how businesses do their work and the penalties if they don't do it in the right way. And then we think, finally, so what could be the impact on this particular entity specifically? So in this case, additional operating and reporting obligations may be imposed on companies such as this due to regulation, such as banks, insurance companies, increased regulation, increased compliance risk. Okay, so that's just an example over there. All right, and then next, nature of the entity. So, for example, banks. We understand that banks are in the business of loaning money. That's just the nature of what they do. So we can use that information, understanding the nature of what they operate in that entity, to identify potential risks. For example, the bank example from before, we would say, okay, so one of the key assets and liabilities that we need to look at is loans payable, loans receivable. Okay, so we need to actually look at this particular account because it has such a big dollar amount, it's probably going to have a larger risk of material misstatement. Here. So number one, debt structure and related items. For example, the terms of a bank loan contain strict financial covenants, and the potential impact might be pressure to meet the debt covenants could motivate management to misstate account balances related to the covenants. Another one could be financing structure. So a company may have a high level of debt owed to its shareholders, and the potential impact on the entity is the classification of debt versus equity and current versus non-current liabilities may be difficult to ascertain. Related disclosures may be misstated. Okay, so let's move on to the third one, which is accounting policies. So the auditor needs to consider the methods the entity uses to account for significant and unusual transactions, changes in entity's accounting policies and reasons for those changes, and finally, the financial reporting standards and laws and regulations that are new to the entity and how the entity will adopt those requirements. So the most important one probably that will come up a lot is IFRS 15. So this is the new revenue standard, and they've also got the lease standards as well. So whenever a new lease standard or whenever a new financial standard, accounting standard comes out, there's always a major risk that the company doesn't understand it correctly and therefore hasn't reported or accounted for it correctly. Number two, may not even be aware of the new change, or number three, they might not have had enough preparation time for the calculations behind it. So even though they had the intention of preparing it and reporting it in the right way, they might not have had enough time to correctly do it. So there's all these risks associated with this. Okay, so number 4 is objectives and strategies and related business risks. So a business risk, the definition of a business risk is a risk that may prevent an entity from achieving its objectives or executing its strategy. So it could result from external circumstances. Most business risks have financial consequences. The auditor doesn't need to identify or assess all business risks, as they don't all give rise to ROMs or risk of material misstatement. It's more about identifying which are the key ones and which ones are going to potentially have the biggest impact across risk of material misstatement. For example, you could have a revenue item which only contributes $100,000 a year in a multi-billion-dollar business. This might have a huge risk for the business. It might be a big business risk in that it's not going to execute its strategy. However, in terms of the audit, because it's such a low dollar amount, even if they screwed everything up in this little subdivision, the impact upon the whole financial statements is going to be very minimal. Therefore, there's no risk of material misstatement there, or very little risk, even though there is a significant business risk. But there is generally a correlation between the two. So understanding what these business risks are can help us plan efficiently the best audit procedures. Then finally is measurement and review of financial performance. So we mentioned before about looking at financial information, doing some analytics to understand how the business is trending and how that correlates to what the assertions management have been making. So for example, financial performance could motivate management to actively improve performance or to intentionally misstate the fin stats. The performance results themselves, such as trends in KPIs, may help the auditor identify potential risks. For example, if there's one ratio which really doesn't make any sense, the auditor might look more into this ratio and discover that there may be fraud or error occurring. Similarly, if we see revenue increasing, even though it might be 3 or 4 or 5% a year, the management's understanding of what's happening in the broader industry, all of a sudden that doesn't make sense. It might be an airline, for example, and we know that all the other airlines are tanking 30% because of COVID. So why is this airline increasing 5%? It might be genuine, but it's potentially an area of risk that the auditor should be looking into. Okay, so let's move on to the next area, which is financial statement level and assertion level risk. So I've already gone through this with you and discussed the two different meanings as to why they're so important. Let's do a quick recap. So auditors need to assess risk in two areas. So number one, financial statement level, which is across the whole financial statements. These are pervasive risks, anything which may impact the understanding or the reporting of financial statements as a whole. For example, going concern, the business may not be around next year, for example, because they might have lots of long-term assets, but they've got no short-term liquidity to pay their working capital, and therefore the business might be going bankrupt, even though its P&L looks good, even though its long-term balance sheet looks good. This might be a going concern, which means the company may not be around for in the medium term. There could be management fraud, which means that the whole financial statements could be wrong. Could be poor record keeping. As I mentioned before, what happens if your accounting software is actually screwing up everything and adding ×2 to every single transaction? That's going to impact the whole financial statements because of double entry accounting. And then on the other spectrum, there's assertion level. You need to assess risk at the assertion level. These are specific risks which normally affect a limited number of balances. For example, carrying value of inventory, or completeness of trade, creditors, account balance, and so forth. So we need to test both of these. Okay, so ahead to assertion level risks, because financial statement risks are relatively straightforward. I think everyone understands them. Assertion level risk is where a lot of exam questions come from. This comes up a lot. It's understanding what each of these mean. It's being able to identify it in a question, and it's about being able to come up with potential audit tests that you can do to be able to test, a certain account balance in a theoretical exam question for one of these assertions. So let's go through what each of the assertions actually mean. What each of these mean. So occurrence is that the transactions and events that have been recorded or disclosed have actually occurred. Completeness is that all transactions and events and related disclosures that should have been recorded and included have been recorded and included. For example, you might have, inventory. When you go and do the stock taking, you see that there's 100 items. But then when you do look in the balance sheet, you'll see that the value in there only correlates to 99, which means that there's one other one that should have been recorded in the financial statements, which wasn't. Accuracy. So this is when transactions and events and related disclosures have been appropriately measured and described. For example, valuation might be wrong. Cutoff. So transactions and events have been recorded in the correct accounting period. So part of this comes down to accounting standards as well, is when do you actually recognize something. And this is important when you've got something which might have been paid on 30th of June, but recognized on 1st of July. Okay. And depending on the type of accounting and what the rules actually say about it is, it should be recognized either on the prior year or next year. So it's very common audit procedures for auditors to go in and look for transactions around probably the last 5 days of the financial year, or whatever the period is, just close to the end of the financial year, and then actually review those transactions, request evidence, and then come up with their own conclusion as to which financial year this should have been recorded in. And they'll do that before and after the end of the financial year as well, just to look if there's anything in there that should have been included in the current year. Classification. So classifications and events have been recorded in the proper account. So you might have something in the wrong account, and that might, even though the amounts are correct in aggregate, it might dissuade or might change people's opinions of whether they should invest if you've got money in long-term liabilities as opposed to a short-term liability, for example. And then presentation. Transactions and events are appropriately aggregated, disaggregated, clearly described, and related disclosures are relevant and understandable in the context of applicable financial reporting framework. So it's primarily around disclosures, but it also is around the appropriate aggregation or disaggregation, but primarily around disclosures. Okay, so each of these ones that we've got here, these are for classes of transactions and events. So it's more to do with the P&L. Could also be cash flow and disclosure notes as well, but it's mostly to do with, when it says transactions and events, it's typically P&L, because if you think about the P&L, it's a series of aggregated events. For example, you might be making a sale today, a sale tomorrow, you do that over a year, and there's your revenue. So that's why this is primarily more towards the P&L cash flow side rather than the balance sheet side. So then moving on to the second category of assertions is to do with account balances and their related disclosures. So this is more to do with balance sheet because you're dealing with account balances. Okay, so the categories of assertions for the balance sheet side are, number one, existence, that all the assets, liabilities, and equity interests actually exist. So, for example, I mentioned before going out for a trunking company and actually looking at the trucks and making sure that what they're saying on paper actually exists in real life. I've seen it, I can confirm that. Number two is rights and obligations, that the entity holds or controls the asset, rights to assets, and liabilities and obligations of the entity. For example, you might go to the company saying they've got $1 million in stock. You go there, you see the stock's all there. That's fine. Existence is fine. But then later on, you find out that the company didn't actually own that stock. That stock was just held on consignment and actually belonged to someone else. So that means the inventory was inflated by, say, $1 million, which is a serious potential issue. So it's actually doing spot checks on certain assets and saying, okay, let's look at the invoice for that. Have you purchased it? Does someone else have the right to that? Okay, next is completeness, so that all assets and equity interests that should have been recorded have been recorded. So it's kind of the opposite of existence. So existence is kind of looking on paper and saying, does that exist in real life? Whereas completeness is looking at things in real life and saying, has this been recorded on paper? If I see it in real life, but it's not on the paper, we need to add it onto the paper. Next is accuracy, valuation, and allocation. So this used to be called something like accuracy or something like that. So this is an area where you can potentially lose marks in exam because you actually have to write out the full thing. Accuracy, valuation, and allocation. And it's also confusing because I know in the transactions or the P&L side, we do have one just for accuracy. But when you're dealing with balance sheet, you remember this AVA, accuracy, valuation, allocation. So this is basically saying that the assets, liabilities, and equities included in the financial statements are at the appropriate amounts, and any resulting valuation or allocation adjustments are appropriately recorded, related disclosures are appropriately. Next is classification, and then next is presentation. So it's fairly similar to what you get for transactions, but with different names. So generally what I would recommend doing in an exam is in our Merit CA notes and critical files, what we've got in here is actually an assertion table, and it's a document you can bring into your exam. Let's just open it up and download it quickly so you can see what it is. It's got a list of all the assertions in there. It's got a definition of what it actually means. Then you've got where it applies to, whether it's transactions, account balances, or disclosures. And then it's got examples. So once you start going through past exam papers, you'll see that a lot of questions ask you to come up with an audit test or audit procedure to actually verify one of these assertions. And what we've got in these notes is a series of examples. So for example, if the exam question says, give us an audit procedure to test occurrence for, this company, we've got example wording over here. So you can see over here it says, select a sample of payroll transactions from payroll records, trace to authorized job card, work recovered. So you'll see later on, once you start doing exam papers, is that the wording needs to be really specific. You need to outline all of the specific tests that an auditor would do. If you miss any steps, or if you just say test payroll transactions, you're not going to get a full mark. You need to go through in detail each of these steps. So let's test another one, cutoff, for example, of transactions. So the audit procedure for that one, per the template we've got, is obtain detailed listing of transactions 1 week before and after year end, trace to invoice, and ensure recorded in correct period and account. So it's very easy to miss one of those steps, but if you don't say all of those things, you're not going to get the full mark. So really useful tool to have. You can copy the wording, mix it up a little bit, change some of the words, or adapt it to your specific question. Okay, so now that we understand what assertions are, it's important to understand, because of the system of double entry bookkeeping, that if you do identify an issue with an assertion, it's going to have a flow-on impact in the financial statements. So, for example, if revenue is overstated due to inappropriately recognizing revenue early in the wrong accounting period, so cutoff, there is a risk that the accounts receivable balance is also out. So just keep that in mind. That it's not going to just have one impact on the financial statements. It's likely to have at least two. Specific risks around accounting estimates just because of their complexity, and also because they sometimes require judgment, and because of that element of estimation uncertainty, and they're generally quite critical to the user's understanding of financial position and the financial performance of the entity. It does increase the level of risk of material misstatement. So it's something that we need to place higher emphasis on in any given audit. So some examples of accounting estimates is, for example, fair value accounting estimates. So this is probably the biggest one of all, because it is quite pervasive throughout financial statements. For example, you might have property, which needs to be valued at what the fair market value is per IFRS 13. But how do you know what the fair value of property is? It's very hard to say. There's no active market like in the share market where at any given day you know exactly how much it's worth. It's really what one person might pay might be different to another one person might pay, and it's quite difficult to estimate it. And that's same for fair value of manufacturing assets. It could be the fair value of assets and liabilities of when a parent acquires a subsidiary, which you need to recognize at fair value. It could be property or equipment and so forth. And then the second major category of accounting estimates is other. So it's not to do with fair value determination, but it is to do with, for example, allowance of doubtful debts. How do you know what percentage of your debts aren't going to be paid? You don't know until it actually occurs. So it's just an estimate. It could be inventory obsolescence. So normally there'd be like a provision or something to reflect inventory going bad. Again, how do you know what that actual percentage is? It could be 0% or it could be 100% for all we know. Same with warranty. How do we know how many of our products are going to go bust or whatever? We're just guessing. Depreciation of useful life of assets or costs arising from settlement of litigation. So these are all potential risks, and these are areas that the auditor needs to spend additional time because they do present a higher risk of material misstatement. So whenever we're dealing with estimates, the auditor must identify the accounting estimates and the risk associated with these estimates, including the related disclosures, the way management identifies accounting estimates, the way management makes accounting estimates, including the underlying assumptions, the experience and competence of those making estimates, the method of making the estimate, whether an expert was used, the relevant controls, whether there was any changes in how the estimate was made compared to the previous year, and so forth. And then finally, the outcomes of those estimates in the prior year FinStats. So estimation uncertainty is a concept where to do with the susceptibility of an accounting estimate and related disclosures to an inherent lack of precision in its measurement. Estimates that have a higher level of uncertainty are highly dependent on judgment, sensitive to changes in assumptions, for example, interest rates, made for longer periods in the future based on inputs that are not observable, or made on inaccurate or incomplete data. Estimates with a higher level of uncertainty present a higher ROM and may be treated as significant risks. Estimates relating to routine transactions or those relying on observable data, e.g. publicly traded securities, are subject to lower estimation uncertainty. Significant risks are assessed based on the inherent risk and are assessed before considering any related mitigating controls implemented by management. So these risks are inherently significant because of their nature, not because of the absence of internal controls. The auditor ignores internal controls when assessing significant risks. It's more just, what are we dealing with? What is the industry? What are the assumptions? Where could this possibly go wrong? I know management have done a great job of controlling it, but no, even the best people can make mistakes. So we need to understand these risks before we take into account those controls. So ISA 240 specifically requires the auditor to treat ROM due to fraud as significant risks. So the factors to be considered is whether there is a risk of fraud, e.g. a casino handles a large amount of cash, which means the entity is highly susceptible to the occurrence of fraud. Therefore, the auditor might determine the cash balance as a significant risk area for the casino. Whether the risk is related to recent significant economic, accounting, or other developments that require specific attention. For example, the entity might be implementing the new IFRS standard, IFRS 15. The implementation represents a significant change in how entity recognizes revenue. Significant judgment is required, therefore this would be a significant risk. The third potential factor, these are just examples, it's not exhaustive, is the complexity of transactions. So a multinational entity might engage in foreign currency dealings across multiple currencies, multiple entities, and multiple countries. It uses hedging to reduce its exposure. However, due to the inherent complexity of those transactions, the auditor might risk hedge accounting and related disclosures as a significant risk area. Next example is whether the risk involves significant transactions with related parties. So a privately held company may have many members of family as shareholders, directors, and employees, which may lead to large volumes of related party transactions. Therefore, the auditor might assess related party transactions and disclosures as a significant risk. So there's a few other examples there you can read. I won't go through it in detail because it's not adding a lot of value. I think you understand the concept. So there's an important distinction between what is fraud and what is error. So I kind of touched on this before. It comes down to intention. If the misstatement in the fin stats is intentional, it's fraud. If the misstatement is unintentional, it's an error. But the requirement of both is there is actually a misstatement. So fraud is intentional, may involve collusion with others, and therefore it's often harder to the auditor to find, which is why the concept of professional skepticism arises. So there's two types of fraud. So number one is fraudulent financial reporting, which is the manipulation of the financial report. And number two is misappropriation of assets. That's like converting the company assets to personal assets. In other words, manipulation of fraudulent financial reporting is, for example, the management gets a bonus based on performance. So they might say, okay, let's just load up this year, get a really big bonus, and then skip out next year. That's manipulating the underlying true financial performance. Misappropriation of assets, on the other hand, might be an employee putting through an invoice and saying, this is a business expense, when in reality, there was no expense incurred. They then bill that them to themselves, and they're basically converting the company cash to themselves, or they're stealing money from the company. So those are the two types of fraud. So we've got this table from the textbook over here under each category. So who might be doing it, owners and management versus employees. And then why. For owners and management might be personal benefit. To save taxes, to sell a business at an inflated price or pay a bonus. Justify an end, e.g. stay in business, save job, maintain, etc. For employees, it might be to obtain a personal benefit, e.g. performance-based bonus, conceal losses, or cover up stolen assets. How, for owners and management, might be the override of internal controls, false incorrect transactions, collusions, manipulations of accounting policy, exploiting weaknesses in internal control. For employees, it might be false or incorrectly recorded transactions, collusions, manipulation of accounting policies, exploiting weakness in internal control. And how much? So for owners and management, often large amount due to position of management in the entity and their knowledge of internal control. For employees, it's often smaller in size but can accumulate significantly over time if not detected. Now, for misappropriation of assets, i.e. stealing, this might be for owners and management. So it might be for why, might be for personal benefit or to help someone else in need. For employees, it might be for personal benefit or to help someone else in need. For how, for owners and management, it might be override of internal controls, theft of inventory, collusion, exploiting weakness in internal control. For employees, it's theft of inventory or assets, collusion, exploiting weakness. For owners and management, often based on a particular need, even if it starts small, will likely get bigger if not detected. Same for employees. So fraud usually involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization. So when you get all three, it's highly likely fraud is occurring. So this is called the fraud triangle. It's comprised of incentive or pressure, 2, opportunity, 3, rationalization. Fraudulent financial reporting often involves overstatement of revenue, which is a key financial performance indicator. Revenue recognition is therefore particularly susceptible to fraud. In fact, auditors have to presume that there is a risk of fraud in revenue recognition unless assumption can be rebutted, e.g. where there is a single type of revenue transaction, such as leasehold revenue from a single unit of rented property. The auditor must evaluate the types of revenue transactions, and assertions that give rise to this fraud risk. This is quite interesting. It's basically saying, from the auditor's perspective, you need to think that there is fraud in revenue unless you can prove that there isn't. So they're taking revenue fraud quite seriously in any given audit. So risk of an auditor not detecting material misstatement is even greater when the fraud is perpetrated by management. Management can often manipulate accounting records and override controls procedures designed to prevent errors, frauds being made by other employees. Auditors always consider the risk of fraudulent financial reporting due to potential management override of controls. Such a risk is considered a significant risk, and the auditor performs further audit procedures to respond to the risk. There's also the risks related from related party relationships and transactions. We talked about this earlier. But a related party is a personal entity that is related to the entity that is preparing its FinStats, e.g. subsidiaries, associated entities, JVs, and key management personnel. A related party transaction is a transfer of resources, services, or obligations between a reporting entity and a related party, regardless of whether a price is charged. So related party transactions, or RPTs, often present a higher risk of material misstatement due to fraud than transactions with unrelated parties. Related party transactions may provide management with both the opportunity and increased financial incentive to perpetrate fraud. So some examples of fraud perpetrated through related parties is, for example, directing the entity to settle transactions for the benefit of the related parties in which the perpetrator has a financial interest, disposing of unwanted liabilities and poor quality assets to a related party, while at the same time recording revenue, misrepresenting receipts as revenue from related parties when side agreements state the reporting entity is obliged to repay the money to the lending related party, misrepresenting receipts as revenue where the receipt is actually an injection of capital, creating fictitious terms of trade with the related party in order to misrepresent the business rationale behind the transactions. So auditors' responsibilities with regards to related parties. So auditors give special consideration to related party transactions due to the inherent risk associated with related parties in general and the significant influence control involved. RPTs may present a great opportunity for collusion, concealment, or manipulation by management. So auditor is responsible for performing audit procedures to identify and assess respond to wrongs arising from the entity's failure to appropriately account for and disclose related party transactions and fraud due to the use of related party transactions. Everything for Chapter 3 Risk Assessment. Look forward to seeing you in the next video.